2024 is almost over and the crypto market has absolutely exploded. Donald Trump came into office. He's already expressed what he wants as far as political changes. He's already expressed, hey, that the crypto market is absolutely going to be the rock bottom foundation for our country. And because of that, the crypto market has absolutely grown from Bitcoin, Ethereum, Ripple, Solana, all these other alternative coins. They have absolutely started to explode. And this is perfect because if you are an early investor inside of the year before this growth within the crypto market, you're probably sitting on unrealized gains, or maybe you've already realized those gains, meaning, hey, you've already taken profit. And what happens when you decide to take profit? You are going to be subject to taxes. It's called a taxable event. Now, come April 15th, when you actually have to pay the taxes for all the income in 2024 or in the year that you incur this, then you're most likely going to be stuck with some sort of tax bill. And there's probably going to be some things that you're curious about of what can I do to lower the amount of taxes that you're looking at potentially facing. Well, in this video, I want to share with you guys some of the strategies that we're able to implement so that you can lower the amount of tax that you could be potentially facing. And in the first strategy we're going to be talking about is tax loss harvesting. Tax loss harvesting is a strategy that you can use to lower the amount of tax liability that you are currently sitting on. Hey, maybe you already are sitting inside of investment and it has depreciated significantly and you're deciding whether you should take profit or take a loss on the investment, which is completely fine. But then on the other flip side, maybe you invest in something and has highly appreciated and you're deciding if I should take profit, right? So for this example, right, maybe you invest in something like a meme coin, you invest into $50,000 worth, it has completely depreciated, maybe even rug pulled, and your investment is now only worth 1,000. And if you decide to take that profit of 1,000, technically you have a capital loss of 49,000 that is in your investment portfolio. But then at the same time, maybe before the end of the year, you invested 50,000 into Bitcoin. It has appreciated. At the time of watching this video, it is right below 100,000, so it's 99,000. Maybe it has appreciated 49,000. You take advantage of that profit because you have 49 capital losses over here. 49,000 capital gains, they can offset one another. Again, you took advantage of the losses over here and you took advantage of the profits. You're not gonna have to pay the profits on this side because you do have some capital losses and they can net each other out, which is a phenomenal strategy if your investments are sitting at a loss. But on the flip side, maybe you do have, some capital losses that are sitting on this side again, that 49,000 that we just mentioned earlier. And you have, your Bitcoin investment where it's sitting at 49,000 in unrealized profit. And maybe you don't want to take advantage of it yet because maybe, you think Bitcoin is going to appreciate much more either next year or in the later years. And you just want to hold the investment, kick the can down the road, which is completely fine. You've already realized $49,000 in capital losses. Well, what you can do is you can take advantage of $3,000 every single year of, 2024 and leading forward. You can take advantage of $3,000 in capital losses, use against ordinary income, and it can help you pay a little bit less taxes. That other 46,000 that has built-in capital losses is going to get kept rolling forward into the next year. And then maybe, once you realize that Bitcoin investment, you can use that against the 40,000 loss or capital loss that you have sitting in a later year. Okay. A third perspective that you need to consider is maybe you invest into a token or a coin and it has depreciated, but at the time of watching this video, you've heard about, the capital loss strategy and maybe you want to take advantage of it. But hey, I also think this token could appreciate back to its original purchase price or even blow past, its all-time highs or set new all-time highs. Then you might want to just go ahead and take advantage of those capital losses, have them realized on your portfolio balance, and then you can buy back in the very next minute, the very next day at that same price, and then ride it all the way up if you have a good conviction within that token. But I do want to say that your basis does reset because you initially purchased it at maybe 50,000 and then, hey, now it's sitting at, 25,000. Your new base is going to be 25,000. So if it does go back up to that 50,000 or even above, your base is going to be reset and you're going to have a higher capital gain. Now, most likely, if you're a stock investor, you're thinking, hey, like this sounds like the wash sale rule. Well, the wash sale rule doesn't apply to crypto as of today. Okay. The wash sale rule is designed for securities and crypto is technically considered property. So those rules does not apply. The wash sale rule does not apply to crypto. and that's perfect because we can take advantage of that today. Strategy number 2 is going to be the charitable remainder unit trust. This is a great strategy if you have held an investment for over 1 year and that asset has appreciated over $300,000 is when it typically makes sense to do this strategy. But if you've held it over for a year, you're most likely going to be looking at maybe a 30% tax on the total investment. And hey, Alan, what are you talking about 30%? It's actually 20% on long-term capital gains. Yes, that is correct. But because it's such a large amount of profit you realize, potentially realizing, then you're going to be subject to that 20% tax. You're going to be subject to Affordable Cares Act. And then you're also going to be subject to potentially state income tax if you enter a state that has that. Okay. And the reason I like the CRUT is because you are able to contribute a highly appreciated token into a trust and continue to control that money and let it cash flow for the rest of your life. I highly recommend that you speak to an attorney so that they can run models for you on order if it makes sense to set up this strategy. And honestly, if they're quoting you anything above $15,000, I would highly recommend that you get a second opinion because that is way too much for the strategy. Here are the steps that you need to be aware of before you decide to sell your crypto or transition it into a different type of token. These are the strategies you need to know before you do all that. Step 1 is speak to an attorney so that they can set up the trust. Step 2 is donate your crypto to the trust. You get roughly 10% of a tax deduction for the fair market value of that donation over 5 years. Step 3 is sell your crypto. Again, don't sell your crypto outside of the trust, sell it inside of the trust because then that is a non-taxable event. And then number 4 is you get to distribute a percentage every quarter of the value of the trust for the rest of your living life. Speak to an attorney so that they can run models for you because this is going to vary on your age, gender, and then actually how long you are going to be potentially living. Again, we only want to do this if we have a huge built-in gain from a crypto investment token that we're looking to maybe realize, or maybe you want to swap for another token, or hey, if you want to donate to Alan, that works too, whatever the case may be. But again, if you have a huge gain, this is a great strategy so that you're not hit with an immediate tax bill on realizing, let's say, $300,000 in crypto assets. Again, we only do this when we are looking at a huge built-in gain from our crypto investment and we're looking to realize it, or we're looking to reinvest inside of another token. You want to do this when it's highly appreciated, typically above 300,000. And I do want to say that in step 4, you are going to be paying taxes every single quarter when you are making that distribution from the trust to you. Now, you might be asking, well, why do I want to pay tax later down the line? Well, it can definitely soften the blow rather than you paying $300,000 outright when you realize it. And at the same time, you're donating it to the trust, you're getting a 10% tax deduction, which is phenomenal. You can take advantage of that and can definitely save you some money on taxes. If you guys haven't done so, please subscribe. I'm going to be creating more content about crypto and taxes, and even just taxes in general for the real world, so that if you guys are generating some huge amount of income, then you guys are going to be taking advantage of some of the tax strategies that we leverage with our clients, so that can lower the amount of taxes they could be potentially facing. So again, subscribe. We're going to be dropping more content, and we're going to hop into the next strategy. Strategy number 3 is so simple and it's often overlooked, and this is what is causing a lot of people to overpay in taxes and they don't even realize it. Okay, this is going to be tracking your bases. Now, this is essentially the same thing in what we call in the real world as doing your bookkeeping, because with the real world, typically if you're doing investments inside of maybe the stock market, right, you're maybe doing it in Fidelity. Hey, you're buying a token Fidelity and you're deciding to sell it in maybe a year or under a year. It's very easy to track that because it's all within one central place. It's going to be within Fidelity. But with crypto, it's very accessible for us to go ahead and move it to a different wallet, move it to a different chain, different network, or a different platform. And you're tracking your bases gets very difficult. So maybe you're utilizing Coinly, CoinLedger to upload all of your transactions, and then it's putting in bases as 0, right? Maybe it wasn't 0. Maybe for a specific example is maybe you bought Bitcoin in at 50,000 within Coinbase, and then you moved it onto Gemini, and then if Voyager comes back, you move into Voyager, and then you move it back into Coinbase, and you're doing a lot of you're moving it around just to get into some projects. Maybe they're saying, hey, we'll give you a percentage of a return. You do that, and then you move it back out to Coinbase. Well, Coinbase doesn't realize sometimes that, hey, your base was 50,000, and it could just say that your base is $0, okay, which is a huge swing because we're looking at the market today, which is sitting right below 100,000, 99,000. Your basis was 50,000, but then Coinbase is registering it as $0, and then you're going to be be potentially taking profit 99,000, you're going to be taxed on that 99,000 rather than just, that 49,000, which is the original basis. So it's important that you are able to track your basis. This is the most difficult thing within the crypto market right now, because again, people are moving, all over different networks, wallets, and it can get very convoluted and people lose track of what their purchase price was. Okay. And this is why it's a huge problem. And this is potentially an investment strategy that you can utilize and, lower the amount of taxes that you're potentially paying. Before I go into strategy number 4, I want to tell you guys about my whitelist opportunity. This whitelist is going to be a course-like format for all the crypto tax information that you guys need to know. Now, if you guys are doing more of the, creative side of crypto, we'll put that information side of there, how mining, staking, meme coin trading, those things that, you're doing within this space, how that is taxed. We'll give you strategies to lower the amount of taxes with that. And then we'll also even talk about some of the legal side of crypto. Like, Alan, what do you mean by legal side? Well, when does it make sense to make an LLC? When does it make sense to make that S Corp election? When does it make sense to make the mark-to-market election? We'll talk about that. And more of a legal, scenario that you want to understand is, what happens when you have all this crypto? Who are you going to designate it as the beneficiary? Because we don't want to have all this crypto and, by God's speaking terms, you pass away the very next day and this crypto asset is completely essentially lost inside the market. You're not designated properly so that your beneficiaries, your kids, your family members, they can properly go get that asset. You're not leaving instructions, and we want to set that up properly so that they can get access to it. Because again, you might have all these gains, and I'm seeing a lot of people have gains, but then they're not setting up properly so that their beneficiaries can get access to it. So we want to talk about that. We're going to talk about so many other things that you guys probably aren't even thinking about from a crypto and tax and legal perspective. So the whitelist gives you 50% off, and then we'll add in little bonuses along the way once we actually release it. Okay. Again, this whitelist is only available in this link down below. Go ahead, you guys can sign up. It's completely free. And then we'll get into strategy number 4 here, which is the Roth IRA. This is a great strategy for all my day traders. I want you guys to leverage retirement accounts. These are absolutely phenomenal. I want to talk to you on a basic level first of what a IRA is, which is an individual retirement account. There are traditional and Roth IRAs. Traditional, essentially you are getting a tax deduction for putting that money in. It's growing tax deferred, meaning you're not getting taxed of all the gains that you're receiving, but then at the time when you retire or you decide to pull that money out, you are going to be subject to taxes. That is a traditional IRA. A Roth IRA is you're getting no tax deduction. You're using after-tax dollars to contribute to an IRA. It's growing tax-free, and then when you retire and you pull that money out, it is also completely tax-free. And the reason I like the Roth IRA is because if you are a day trader and you're actively trading, you can do that trading within an IRA account. You just have to set it up with a custodian that allows you to self-direct into maybe the more meme tokens that you guys are looking at. All those gains that are sitting inside of an IRA could be tax-free when you retire, which is phenomenal. If you're taking an account of $7,000 and you're taking it in a couple 20-30 years when you decide to retire, it's going to be maybe 50,000. All that tax-free money that grew is going to be tax-free when you decide to withdraw it. Well, Alan, my Fidelity account doesn't allow me to invest inside of these meme coins or directly into Solana. They're only giving me ETFs and other mutual funds. Well, there's nothing wrong with those ETFs, mutual funds, because essentially you're hedging with the market itself. But maybe you are a degenerate and you're wanting to invest more directly with the token itself, which is completely fine. You have to be aware of self-directing. This is a term that's not very tossed around with Fidelity. They'll say, hey, it's self-directing. They're just going to give you a pool of things that you can invest in, but maybe there's nothing in that pool that you want to invest in. Self-directing allows you to invest directly into what you want, which is phenomenal because those gains could be potentially higher than maybe an ETF or a mutual fund. Just make sure the custodian actually allows you to self-direct. I do have an alternative. If you guys want to email us down below, and I'll actually leave my email right here so that you can message us and we'll send you over directly to the custodian that we recommend. They'll help you set up the account. They'll give you the instructions so that you can go ahead and go about trading inside of meme coins or directly into the market of whatever you want. Again, this is a great opportunity so that you can invest inside of a retirement account, and all that money is tax-free. You don't have a tax problem. We're not paying taxes, and then we're all happy. Last thing to note is that maybe you guys are saying, hey, this is a retirement account. I only get it when I retire. There's nothing wrong with setting money aside, maybe that $7,000 that you're able to contribute this year in 2024, contributing that money into the account and just trading it. it. You know, it might not be the main account you're trading, but it's definitely something that we want to have set aside, our different buckets of wealth, which is our retirement account. We're setting it aside for the future so that we can have something set up when we actually retire. Because last thing you want is, and you can ask so many of the older people that are retiring, is they don't have money set aside. So I definitely want to have this option and this bucket available for us when we do decide to retire. And, you know, we're not looking down the barrel of, dude, I'm 60, I have to get back into the workforce. We don't want that. This allows you the opportunity to set something aside and really build some wealth. And probably at the beginning of this video, some of you guys heard about Roth IRAs and you guys like, hey, Alan, I can't do it. I'm over the contribution amount. I'm over the threshold. Well, what you can do is a backdoor Roth IRA. Again, the thresholds, I'll leave it right here below so that you guys can see actually what the thresholds are. If you are above this, you technically cannot contribute to a Roth IRA, but we are going to talk about the backdoor method real quick, where you're going to set up with your custodian, you're going to make a non-deductible contribution to a Roth IRA account. And then day 2, the very next day, you're going to transition that into a Roth IRA, which is completely legal. Super simple and easy to go ahead and start trading within your retirement account, especially if it is going to be a Roth account. Those are just 4 of the basic strategies we leverage with our clients so that they can lower the amount of taxes they owe, because there are so many different strategies that you can utilize, especially if you guys are getting more creative with what you're doing within the crypto market, like staking, mining, NFT trading, NFT flipping, loaning, or hey, maybe you guys want to leverage the advanced strategies like real estate in order to offset your cryptocurrency gains. There's obviously that opportunity for you guys to leverage too. What I'm going to do is I'm going to drop my calendar link down below for you guys to go ahead, schedule a free 15-minute discovery meeting with myself or my team so that we can analyze your situation, see how we can help you in any way. There is going to be a deposit. This deposit will be refunded once you guys show up to the call. Again, the deposit will be refunded once you show up to the call. I just want to be wise of, you know, everybody's timing so that, you know, for the serious investors within the crypto market, they absolutely do need help. And this deposit will allow us to make sure that, you know, both of us are showing up and we're valuing each other's time. Okay. So again, the discovery meeting is going to be down below. I look forward to hearing your situation within the crypto market, what you guys are doing, because there's so many crazy ways that I'm seeing people make money within the crypto market. And stay tuned. Bless.